Money has to have a home. Don't choose a house of straw or a house of sticks. Choose to put your money safely tucked in a house of bricks. I'll explain next. I'm Doug Andrew, and I'm going to answer in this educational episode how you can benefit when the stock market or real estate market does well and avoid losses when those markets have downturns. I'm going to show you what I do with my serious cash. So I've been helping people optimize assets and minimize taxes now for north of 48 and a half years. And I'm going to explain to you what I mean by keeping my serious cash. This is money that I don't want to jeopardize. I don't want to lose. It's earmarked for future goals like retirement or maybe college funding for your children or grandchildren or your business or what have you, so that you do not lose when the economy, the markets, the stock market, the real estate market goes down. Even though you can participate when the economy, those markets are going up. So here we go. I alluded to the story of the three little pigs, houses of straw, sticks, and bricks, if you recognized that. So as a financial strategist now for nearly 5 decades, I've noticed there's a lot of people who like to invest in real estate. I do too. I don't have a huge real estate portfolio, but I probably have owned and invested in more real estate than most Americans. And I would consider real estate to be a moderate risk investment. There's various ways you can own real estate. If you understand safe, positive leverage, you can own and control assets like real estate with very little or none of your money tied up or at risk in that asset, because if you leverage without liquidity, that's stupidity. This video episode is not about that. I have other educational videos on the 3-Dimensional Wealth channel that talk about how I own my real estate. I will simply help you understand that I own real estate, but I keep my money, the money that a lot of real estate investors tie up in their real estate properties in the form of equity or sending extra principal payments against the mortgages or putting huge down payments or paying cash for those real estate properties. They are violating the key elements of a prudent investment: liquidity, safety, and earning predictable rates of return. Because if you get into trouble and the real estate market crashes and you need money or you have vacancies because you are renting that property and you need cash flow or you need to be able to meet the mortgage payment or what have you, there's only really a couple of ways to get your money out of a piece of real estate, and that's to sell it. And sometimes you don't want to sell it in a down market because you may end up giving up hundreds of thousands of dollars that you would have in there if you waited till it was a better market, or you have to refinance the property and borrow back money that you were giving the mortgage company. And I have found that when you need that money the worst, it's the hardest to get, because they're not going to loan you money based upon just the asset. They're going to loan you money based on your ability to repay. So if you don't have the ability to repay, they're going to say, sorry, fat chance, you can't borrow on that piece of property. And I've seen people lose properties that they've been paying on for years, and they lose it in foreclosure because they lack liquidity. They don't have safety of their principal. But real estate, yes, I've benefited many times from owning real estate. But I don't keep my cash in the real estate. In fact, I've never paid a down payment out of my pocket for any piece of real estate I've ever acquired. I've satisfied down payments, but not with my money. I keep it safely tucked in a house of bricks, as I'm going to show you here in a moment. Now, the other main area that a lot of Americans put their money is in the stock market, whether it's in stocks or mutual funds or what have you. And they hear the phrase, okay, there's only 3 things you can do with money: spend it, lend it, own with it, or actually there's a 4th thing, you can give it away. Well, a lot of people assume that the best option is always to own with it. So let's own some real estate. Let's own some stocks. Well, I like to own and loan on the same asset. This is like double dipping, and I'm going to explain this to you here. So the stock market can do well, but as you know, the stock market is like a house of straw compared to the real estate market. The real estate market can be volatile, but it's a little bit less volatile than the stock market. The stock market can take a nosedive of 5, 10, 15, 20% in a day or a week or a month. Usually real estate will not react that hard, that fast. And so the stock market, I compare to like a house of straw. The big bad wolf, the recessions, the rumors, the things that go on, the tsunamis, the physical disasters and what have you, cause economic ripples and tsunamis to happen. And so the stock market can crash. Well, I get to participate when the stock market is doing well, when it goes up, but I don't want to lose when the stock market has a crash. So how do I do that? I keep my serious cash safely tucked over in a house of bricks. Now, what's a house of bricks? It's an investment where your money is not subject to that volatility, where when the market goes down, because the big bad wolf, who's the big bad wolf? Some people say that's the IRS. Well, yeah, but the big bad wolf in this particular situation would be those things that happen, whether it's pandemics or whether it's a crash or it is a tsunami, a physical disaster. People panic and it ripples and the stock market all of a sudden takes a dive. We see this all the time. You want to have your money safely tucked over in a house of bricks, in my opinion, so that you do not lose money when that house of straw gets blown over by all of these external forces and influences, okay? Well, the same is true of real estate. I don't want to have my money all tied up in a bunch of real estate properties when the real estate market goes down, because sometimes it'll drop down 5, 10, 15, 20% or more, and then it takes several years to come back. Why do you want to do that? Sometimes it takes 4 or 5 years for the stock market to make back what you lose in one single year, like 2008. So when we look at the house of bricks, you could have your money in a bank, in a money market account or CDs, but you're going to be rowing upstream at the rate of maybe 1 mile an hour, 1% interest, and the current of inflation is coming down at 10. You're going backwards. So that is not where I put my serious cash. You could put money into an annuity, but that's only tax deferred. I've never owned an annuity. I doubt I ever will. They're okay. They're better, especially an indexed annuity. Bonds, okay. But my favorite, without question, is a Max Funded indexed insurance contract. This is where my money is safely tucked into the backbone of America, the insurance industry. It's also the backbone of the world. And insurance contracts allow me to put money into the insurance company, and I can take the least amount of insurance the IRS will let me get away with if I want to earn a high rate of return. If my objective is high rates of return and high income payouts on my money, where I could have $1 million generating $80,000, $90,000, $100,000 a year of tax-free income without depleting the $1 million nest egg. People say, really? Oh yeah, that's in a Max Funded insurance contract. So in other episodes on this channel, I talk about how to structure an insurance contract or policy to do that. My favorite is an indexed universal life insurance policy because my money is in the insurance company safe. The insurance company's paying me maybe a general account portfolio interest rate of, let's say, 4%. Back in the 1980s, I was earning between 11 and 15%. But if they only pay me 4% in a low interest environment, that's 4 times what banks are paying. I'm earning $40,000, but anytime I want, I can let them take that $40,000 of interest to buy upside options, so they'll have the wherewithal to pay me 8% or 12% if the stock market goes up. But if the stock market crashes, gets blown over, my million is still safe over here in the house of bricks. I simply gave up the 4% that year on my million. So I get to participate when the market goes up, which it's going to do about 70% of the time, and only 30% of the time does it get blown down in any given decade. Now, I know the decade 2000 to 2010, there were 5 years the market was down, and only 5 years it went up. And my money in a house of bricks still doubled. $1 million doubled to $2 million in the worst decade since the Great Depression. So I want to participate when the market goes up by using a strategy called indexing. That's not an indexed fund. If you had your money in an indexed fund, it would be in the house of straw and you would have lost 40% in 2008. Instead, I didn't lose a dime in 2008. None of our clients did. They were cheering. And the first 90 days of 2009, most of them locked in gains of 16% tax-free after not losing a penny in 2008 because their money was not in the market. It was linked to it. So when the market goes up, you get to benefit. When the market goes down, you don't make much of anything, if anything, but you don't lose. Same thing with real estate. When my real estate properties go up in value, I benefit. But I keep my equity separated from it. I don't pay huge down payments. I don't pay cash for the properties. I don't take the positive cash flow from a rental property and send it to the mortgage company. I keep it safely tucked over here into Max Funded Indexed Universal Life. And if you want to get out of debt, you'll actually get out of debt 2.5 years faster, putting it over here compounding, tax-free. When you're borrowing money, maybe at 4.5% tax deductible, it's only a net cost of 3%. Or if you borrow at 6% tax deductible, it's a net cost of 4%. And I've been earning 8 or higher. How much more is 8 than 4? Don't say 4, it's 100%, it's double. On $1 million, would you pay $40,000 to make an extra $80,000? Would you hire an employee for $40,000 that made you an extra $80,000? Would you buy a widget machine for $40,000 that made you an extra $80,000? That's called a 100% return on employment cost or equipment costs. So I keep my money safely tucked in a house of bricks. The best option, you'll find out if you read a book I'm going to gift you at the end of this episode, would be a Max Funded insurance contract. I'll give you a glimpse of what they do. So Warren Buffett had 2 rules of investing. You've probably heard this. He said, don't lose money is rule number 1. Rule number 2 is don't forget rule number 1. Well, people go, well, that sounds pretty clever, but how do you do that? I just told you. With Indexed Universal Life, see, if you took a series here, series 1, which is a taxable stock market investment, and $100,000 grew up to here, and then the market went down and then came back up again, okay, you have to experience that yo-yo effect with your money. So it goes up and then it may come down to 152,000. But if you used indexing, you participate, maybe not as much when the market goes up, but you don't lose when the market goes down. So at this point, instead of having 152, you still have 189,000. And then the market recovers and you would have 238 here, but at the end of this 10-year period, you have 269. I'd rather have this one and eliminate this heartburn of this downturn in the market. Does that make sense? That's having your money in a house of bricks. So a lot of people hear me say lock in and reset. What is that? With indexing, if you had $100,000 in an indexed account compared to in the market, and the market went up 10%, it would be worth $110,000, right? But what if the money's in an indexed universal life? That $10,000 now becomes newly protected principal. Because if your money's in the market and the market drops 10%, you would lose 10% of 110. You'd be down to 99,000 with your money in an indexed mutual fund like the S&P 500. When you're linked to an index, you don't lose. You can have a floor, let's say, of 1%. You have 111, your money in the market's down to 99. Let's say the market rebounds 5%. Here you'd end up with 103. You'd barely be 3,900 over the break even. But here you'd have 116,000. This is just a 3-year period. That's a 12.2% better rate of return because you're able to lock in your gains and reset. It's like a ratchet wrench where you're cranking up, but when the market dives, you're not undoing the progress you made. You're just going click, 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 and then you start tightening again and making money again. It's incredible. So this is where I put my serious cash in a house of bricks. The million or whatever I have in my insurance policy, and you can extrapolate from this example, allows the insurance company to take the interest, let's say 4%. They can pay you that, or they can fund an options budget, which allows them to pay you 8 or 10 or 12%. Or if the market crashes, the options expire worthless and you don't lose your million, but you don't make anything, but you don't lose the principal, which is what most people are concerned about. So when you look at periods of time from 2007 ending in 2012, there are times where indexed universal life, maybe 0 was your hero. But at the end of the day, even if your cap was 10.5%, this is out of the book I'm going to gift you, you would end up with $691,000 in that short time period from $500,000, instead of still being under the $500,000 at the end of that time period with your money in the market. Here's an actual statement of a client who had $18,000 in March of 2020 in a portion of his IUL policy, and his advisor said link to a 1-year point-to-point with no cap. Why? Because of COVID-19, the market dropped 30%. That spells opportunity. 1 year later, he got credited 61.33%. The market was up 66.33. When you choose that option, they subtract 5 percentage points, which normally you wouldn't do in just normal markets. But when the market drops 30%, that spells opportunity. He ended up with $29,000. Here's a fellow that had $852,000 that same 12-month period, March of 2020 to March of 2021. He made $535,000 that year, tax-free. He ended up with $1,387,000. He didn't add a dime to this. Now, if the market crashed the next year, how much of that $500,000 he made the year before would he lose? Not one dime, because that gain becomes newly protected principal. You lock in that gain and reset. The next year actually didn't lose, but if it had of, he would have kept his $500,000. That's the beauty behind having money safely tucked in a house of bricks. I want you to understand this. And so I mentioned I wanted to gift you a copy of my most recent best-selling book. It's flying off of our warehouse shelves. We're sending out about 1,000 of these a month. I don't want you to miss out. I will pay for the book. In fact, I just ask that you contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost and pay for the book and fire out a hard copy to you. You simply go to laserfund.com, L-A-S-E-R fund.com, or click on the link below, and you'll see options there if you want to listen and learn or watch and learn. There's even a choice if you want to talk to an IUL specialist to see how this may help you in your particular set of circumstances, and you can just fill in an appointment if you would like with an advisor, a professional that I've trained, that I oversee, that I point my students to. They will not bill you for their time or anything, okay? It's worth checking out. But claim your free copy. This is 300 pages of charts, graphs, and explanations. You flip it over, and there are 62 actual client stories that talk about how the Laser Fund can be the dream solution for many of your financial goals.